Sunday, 2021. Thought we'd do something a little bit different here. Just take a look at a video that I came across. Definitely something that we should be aware of come a couple of months down the road. But this is something that I've been thinking about a lot for the last 6 months of the year. Going into 2022, this is something to really think about.
The bond market.
It's not as sexy of a subject as stocks are. Just that shroud of mystery and mystique and complication over the bond market.
The corporate bond market, where companies can go to borrow cash. Now companies are facing the highest debt levels ever. More than $10.5 trillion in debt.
The corporate bond market now is kind of just hanging on by a very precarious string.
These debt levels were massive before the coronavirus pandemic. Super low interest rates left over from the 2008 financial crisis made it very easy to borrow money.
That the debt market could even lead to the next economic crisis.
We couldn't have predicted in 2018 that a global pandemic would cause the next recession. But the point is, corporate debt was reaching record levels then, and it's even bigger now.
You asked about corporate debt.
Yeah, I'm just concerned if that's a bubble that you're watching.
We do watch those things.
This after the Federal Reserve took extraordinary measures amid the pandemic-induced recession to buy into corporate bonds.
The high yield market is now at bubble levels, and this is not going to end well.
Some of the most influential companies are issuing these IOUs, and some of those are junk bond status, or in other words, the riskiest kind of bonds, like Kraft Heinz, Ford, and Macy's.
It's like double B.
How long can we continue to do this run up in debt? How long can we continue to live on red ink?
As of the fourth quarter of 2020, there was over $10,562 billion in U.S. corporate debt. Most of that is made up of bonds. So companies can issue stock to raise money and finance all their business dreams. Or companies can borrow the money. And when you borrow money, you're indebted to someone somewhere for that cash. That leads corporations to issue bonds, corporate bonds.
With interest rates really low, it's very easy and accessible to issue bonds in today's market. If I had to put it in terms of analogy, it's like anyone looking to get a mortgage loan or refinance their really high interest rate loan and maybe refi into something lower.
When you buy a bond, you become the lender. You're basically saying, yep, company, I believe in you. Here's some money, go make it happen. And that company says, thanks for believing in us. We'll throw in a little extra to make it worth your while. That's what finance folks call the coupon. So whatever you pay to buy the bond, which is called the principal, you'll get back eventually, plus that little extra.
Hopefully.
Those coupons are paid out to lenders over time, which depends on how long it takes the bond to mature. It could be in 1 year, 5 years, or even 30 years. It's kind of like a long game of Monopoly. Every time that bondholder passes go, they collect their coupon. That's why Wall Street calls this fixed income.
Just as consumers have FICO scores, companies also have scores themselves, given by independent rating agencies.
When a company has a good credit standing and Wall Street thinks that the company can make their debt payments, they're called investment-grade bonds. Then there's the opposite. If a company looks like they're potentially unable to repay those debts, that's a high-yield bond, also known as a junk bond.
Corporate health right now is good. And as long as corporate health stays good, then the state of the debt markets stays good. When corporate health goes south, the bond market goes south. The bond market is bigger than the stock market by multiples. So when the bond market blows a gasket, the damages are much worse for the economy.
Here's what's happening now.
In the corporate bond market, we're seeing companies issue debt fairly consistently.
And one of the reasons why it's not out in the forefront more is simply because right now the corporate debt picture looks pretty good.
That's because interest rates remain so low, and that lowers the cost of borrowing money.
Companies would rather use cheap debt than to dip into their own cash piles.
And the pandemic is only part of the story.
Corporations in the U.S. have been on a corporate debt accumulation binge for most of the past 10 or 12 years. It's come as interest rates have stayed low. This would trace back to really the financial crisis.
Everywhere you look, the color is red.
In 2008, the Fed has taken their benchmark short-term borrowing rate down to zero. Companies just decide, we're going to go out and take advantage of this.
You see companies being very opportunistic. And it's great during periods like we are now where things are great. It feels like the economy is starting to pick up. You have vaccine distributions, but sometimes companies can get reckless. Sometimes what will happen are these companies do get downgraded and then they cross over from this bucket from investment grade to the lower quality high yield area. You're either in one of these two buckets. There's nothing in between.
Right now, there's a ton of companies right at the edge of that investment grade cliff.
So when bonds are downgraded from investment grade to high yield, it almost falls off a cliff, meaning there's a lot of selling pressure that takes place. Asset managers can't hold these bonds because it's crossing over. And so you'll have this unique opportunity set where managers will force sell.
There was a big concern about what we call in the bond market fallen angels, which is basically a company that had been barely investment grade. Those companies get downgraded.
And in 2020, rating companies downgraded several of these fallen angel companies.
50 companies were downgraded last year alone for over $200 billion in debt.
Like Macy's, Ford, and Occidental.
Normally, it's a handful of companies that are downgraded each year with 40 to 50 billion in debt that's downgraded. So that puts some context as that's a very unusually high number.
Even during the pandemic era, the situation has not deteriorated anywhere near what some folks in fiscal and regulatory areas thought.
You've seen relatively significantly fewer defaults than we expected.
When the pandemic struck, the Fed announced that
Don't
part
listen
of
to
its
that guy.
monetary policy actions would include buying up corporate bonds, which floods the market with more liquidity and keeps the quote too big to fail banks stable during a time of crisis.
The amount of bonds that the Fed actually purchased was very small versus what they could, which meant just the Fed coming out, announcing it, setting it up, doing a little bit was more validating to the market than the actual desire to buy everything.
Despite trillions and trillions in U.S. corporate debt, you could say the potential bubble is benign. For now.
None of these things have been a big problem so far, so it tends to make the market more and more sanguine about the state of corporate debt. But there are issues, and one of those issues is what happens if things change.
There are a few things that can make this massive amount of debt a problem.
Now, there are a number of factors out in the marketplace right now and in the economy that could generate higher inflation.
Inflation is basically how much bang you get for your buck. When prices of goods and services go higher, the purchasing power of a dollar lowers. If the U.S. economy sees a lot of inflation, or if consumers start spending a lot more, then interest rates may go up.
Which, of course, makes that debt more expensive.
And a lot of people are actually saving tons of cash right now.
That money starts to get put to work. It creates price pressures in the pipeline. As those price pressures get built up, the Fed's got to come in and combat that. And the way they combat that is by raising interest rates. Even a 100 or 150 basis point interest rate could spell doom for a company that's really living on the edge. So what happens if the economic conditions continue to deteriorate? What happens if interest rates start to go up? And that interest rates going up is the most important issue at this point because you have what we call zombie companies.
Zombie companies are companies that are drowning in debt, but not so much that they'll default on their loans. These companies are doing just enough to skate by. It's like being only able to make interest payments on your credit card bill or on your student loans.
We've got a lot of zombie companies that are still alive that shouldn't be alive right now.
It's actually across the board until where you're finding zombie companies.
It could be a problem in the future.
It's a future problem because these companies ultimately put a strain on economic growth. Because they're only making interest payments. They're not investing in their businesses or employees.
Yeah, what's next? That's a great question.
When you think about all that debt that's being out there in the pipeline, what if something goes wrong? What if rates start to go up? What happens? It's a daunting thought.
You have companies borrowing money at all-time highs. Can they pay it back? And so as an investment grade manager, we're always looking to see which of those companies can't. Last thing you want is companies just going bankrupt or defaulting.
For now, the Fed isn't going to raise interest rates anytime soon.
You get overconfident and you just think, the Fed's not going to raise rates. Debt's going to stay cheap. This is sustainable. This game can go on forever. Think about playing a game of Jenga, and you just kind of pull that one little thing out there. And it's like, okay, we're still standing. And you just keep pulling things out. And you never know where that thing is going to get pulled out, where that's going to bring the whole thing down. And everything collapses. And it's a bad thing. When does that happen? I don't know. But it's something that everybody should be thinking about.
All right, so basically that outlines what I think is going to be the next crisis. Everything I think we should be worried about, when it comes to corporate bonds, corporate debt. I mean, this also falls along, with the U.S. debt. So you can see from right now, we are above 100% GDP, which means the gross domestic product of everything that we put out as a country. We actually have more debt today than what we produce, meaning that we're in a deficit, and that deficit is growing. And as you can see here, that deficit is going to be somewhere in the range of about $2.1 trillion. So that is going to have like a pretty pronounced effect anytime that the yields go up on the treasury market. So when those bonds and the way that this all works is that when the price of a bond goes down, yields go up, right? So the sell-off, meaning that the dollar price of treasuries is starting to go down, that means that people are going to be wanting a higher yield. So that is going to be a fairly big issue, I think, going down the road. Now, again, I'm still long everything in terms of equities, but you have to understand that this deficit, right now it's gone up 1 trillion. They're going to add this additional 1.9 trillion into the economy as part of this stimulus package we all know and talk about. But then on top of that $1.9 trillion, they're talking about, having another infrastructure package put together. So that's going to be just more money. So it's just more money being printed and diluted into the whole system. So, all this money, eventually, you got to pay it back, or you just got to keep on printing more money. And if you print more money, then the value of the actual dollar itself is going to go down eventually. And so everyone's worried about inflation when they rightly should be. But right now, we're still long. We're still long the markets, but we're very, very, very cognizant of this. Not only the corporate debt that's going to have, that's one shoe falling, but also government debt. Right now, if you look at Fitch, which is, one of these credit rating agencies that they talk about, they're still maintaining, because it's AAA, right? So the U.S. government is still considered AAA, which is the highest rating that you can have for whether it's a company or a government. But here's the thing: negative outlook. So they're pretty concerned. You can see here fiscal year. That means for 2021, looking so far where we are right now, but looking forward, it looks as if for the year it's going to reach 15% of GDP, which is just that's just unheard of. We haven't seen anything like this since World War II. But again, these are things that we're aware of, and here I like this. It takes it all the way back to 1929. You can see here in terms of the deficit, this is in billions. You can see how as a percent of GDP, anything that's here as a negative is considered a surplus. We haven't seen a surplus since the 1990s, but you can see the last time we ran it up was again in the last World War, the World War II. And now you can see here again, this is in billions right here, what the deficit is. You can see if you start to scroll down here, the last time we ran it up on the deficit mark was back in the mid 80s. Again, that was when Ronald Reagan was president and was put a lot of money into not only cutting taxes but also increasing spending. So the combination of those two things have just really put a lot of money onto the government's balance sheet. But you can see that even during those times, it stayed relatively within 5-6% of GDP, meaning 105, 106%. But as you go down the line, you can see like this is what I was talking about. So back into the early 90s or late 90s, this is when Bill Clinton was president. We actually had a surplus in debt. So we had a credit, didn't have a debt. But you can see since the late 90s, things have gotten a lot worse after the financial crisis. You remember back in 2008. So it really popped up then. And now, today. So you can see where we are today versus where we were back in the crisis. So we are in full-on crisis mode, even though nobody wants to recognize it. We are. But with the 1.9 trillion stimulus, we are still very bullish on the markets. And the reason why I spend so much time here is just to look forward into the future. But I already made the updates to the portfolio, and there's really not much to be said here. I really didn't make any changes whatsoever. The only things I want to highlight here was the really big gains, weekly gains that we saw in Bitcoin. Again, I think this is just a factor of people just moving more towards alternative values, and it's getting sucked out of the gold. A lot of these investors are moving to digital, and a lot of these investors are part of this younger generation. So these millennials that are going in and really gobbling up and driving up the price of Bitcoin. I mean, 24% in 1 week. I mean, just a week ago, it was like it was skirting around $50,000, and now we're over $60,000. So we're obviously well above my target price of $50,000. I still think this has room to run, probably up to 75,000, but we'll see. But you can look, I added another column here, year-to-date gain. I mean, 79% gain just since January 1st. I mean, that's unbelievable. And you can see how, gold took a hit, not only with everyone going over to Bitcoin, but also what I was talking about before in terms of the inflation scare that people are talking about. And you can see in the treasury markets, you can look up the 10-year treasury as it, has moved at least 50 basis points, if not higher, just in the last, couple of months, which is a very, very big move up. 50 basis points means a half a percentage point, but a half a percentage point might not sound like a lot, but when you're down to like 1% for a 10-year treasury, which means that the government is only having to pay a 1% interest rate. When that 1% moves to 1.5%, as a percentage, that's a really big move. So you can see here, really for year to date, the only weekly, and we're still hanging in there with the China ETF, but for the most part, for most of these ETFs that we own, we are positive, and the only one that is negative is exactly what we were talking about here, inflation, right? So treasury inflation. These tips, this protection really, with the speed at which yields or treasury bonds are selling up and yields are going up, it's definitely a negative effect on our tip position. But aside from that, you can see, as we come out of the COVID crisis, you can see that our names here for Marriott Vacations. A lot of people think that now that this vaccination is being distributed a lot quicker than we thought. People are going to be, again, this whole pent-up demand, it's going to be moving towards people going out, getting out, spending money, going to hotels, and going to restaurants, all that stuff. So that's why we put the vacation, and we put Wyndham here. And Wyndham actually changed their name. I didn't find this last time, but I did look it up. And it looks as if they bought Travel and Leisure. So their name is actually changed to TL, I think it's like TLC or something like that, or I forgot what it is. TLP? Here it is. TNL, sorry, so Travel and Leisure Company. So that happened back on February 17th. So we're going to go ahead and add that to our portfolio so that we don't, so we call it by its right name, or TNL. All right, there it is. So I've added all those numbers. I've updated them all for the week. And again, you can see where we're at right now, 1,075,000 for the portfolio. We started at 1 million. That means it's a 7.55% gain for the year. And a lot of this is being contributed to the Bitcoin run up. So here, we'll just update the allocations for the portfolio. And I'm sure this is going to show quite a bit of a difference in the allocations, when it comes to the Bitcoin and percentage of Bitcoin as relative to the entire portfolio. Oops, we want category name here. There we go. So you can see here in our portfolio, really, Bitcoin is now at 6%. So it's creeping up a little bit more and more. So it's taking more of the overall pie. But we're still long equities when it comes to the S&P 500. And, again, what we did a couple of weeks ago is that we reallocated some of our S&P positions actually from cash into equal weighted S&P, because a lot of those super fast growth tech companies are really taking it on the chin because of like what we were talking about before, which was the yields really hurting those kinds of corporations because the cost of debt for growth companies is becoming bigger and bigger. And again, a lot of these tech companies are not making any money, and they're just taking on more debt. So that's just putting them more into the hole, and their valuations are even going higher and higher. So ETF, I don't have it on here, but ETF like the Qs, you would have seen for the NASDAQ, a fairly large drop week to week. And I really think that really has been reflected in the rotation, and that's the reason why we bought more of this Invesco equal weighted S&P, so that we can move more away from the tech companies and more into the cyclical companies that's taking advantage of this whole reopening of business. So so you can see here 7.55%. We're really just crushing it right now. I need to add or just see where we are with the corporate debt out there. Again, we already saw the video, so we saw that there's been hasn't been a very good year for bonds, whether it's corporate bonds or treasuries. Let's see. So 2312. S&P. Okay. Go to the financials here. Let's go back to Yahoo. 3943. And the Dow Jones. So the Dow Jones has done quite a bit better than the S&P 500. Again, it goes back to what I was saying before, because the S&P 500 is so tech heavy, because again, it's by market cap, meaning that whatever the biggest companies that are out there take a larger percentage of the overall ETF or the S&P 500. All right, so the Dow Jones 32,779. You can see 2.91%. Wow, that is a big week. Look at that, or 4% move. That's pretty amazing. So the Dow Jones is really catching up. So that is something definitely to be aware of. I mean, we're not going to try to, follow big gainers. So we're going to keep our positions, and a majority of it being still in the S&P 500, the VOO ETF, because we might be able to see a rebound in some of the bigger tech names come next week. But you know, for now, I think it's you know, we're still in a fairly good position, and we're still ahead of the indices. But it looks as if the Dow Jones is really trying to catch up. All right, guys, thanks a lot, and speak to you next week.